Hello, ladies and gentlemen. I hope you are fine wherever you are. I am Jeremy Timkulu, the lead Acca tutor at Consulting Services. In this course, we are going to look at consolidation of basic groups, the statement of financial position side. Okay, so we have got a number of objectives which we need to achieve by the end of the course. The first objective is we need to define and describe a group. Critically explain the following in the context of group accounting. Number 1, a parent. 2, subsidiary. 3, control. 4, consolidated or group financial statements. 5, non-controlling interest. And lastly, trade or simple investment. We also need to recognize and calculate the various forms of consideration transferred in the acquisition of a subsidiary, including their accounting treatments. Calculate goodwill using the full goodwill method and describe its treatment, including that of negative goodwill. Describe the components of and prepare a consolidated statement of financial position or extract thereof, including the following adjustments. Number 1, fair values. 2, intra-group trading. 3, unrealized profits. 4, acquisition pathway through the year. And lastly, we need to discuss the treatment of simple investments. Now, what is a group? A group exists where one entity, the parent, referred to as the investor, has control over another entity, the subsidiary, referred to as the investee. Thus, a group where we have a parent and its subsidiary. So it's a setup where we have got both a parent, which is the company that is controlling another, and the controlled company, which is called the subsidiary. In accordance with Ifrs 10, that is International Financial Reporting Standard number 10, consolidated financial statements, 3 criteria must apply if one entity is to be said to have control over another entity. Number 1, power over the investee, which is normally exercised through the majority of voting rights, that is usually owning more than 50% of equity shares. So when you are talking of equity shares, these are ordinary shares. Okay, so the first criteria, okay, is that one should have power over the investee, or the parent should have power over the subsidiary. Okay, and this can be seen by having more than or owning more than 50% of the ordinary shares. Criteria number 2 is exposure or right to variable returns from involvement. Okay, variable returns, these are not fixed returns, but returns subject to the changes of business operations. Okay, when the operations are positive, you're going to also gain something positive. When things are bad, you're also going to bear the brunt. So we are saying this company or the parent has exposure or right to variable returns. Its returns are not fixed, they are variable. For example, a dividend. Sometimes the dividend might go up, sometimes it might go down. Then the ability to use power over the investee to affect the amount of investor returns. This is regarded as a crucial determinant in deciding whether or not control is exercised. So the parent should actually have the muscle to determine how much they should get out of their investment. Okay. Now, what is a parent company? The parent company is the company that controls the other company. A subsidiary company, on the other hand, is the company that is controlled by the parent. What about consolidated account? Because this course is about basic consolidation. So what is a consolidated account? All right. Consolidated accounts are the accounts for the whole group, where we treat the group as though it is one big company. So no matter the number of subsidiaries they are, when we are talking of consolidated accounts, we are saying the parent and its subsidiaries are going to be amalgamated, are going to be accounted for as one whole group, okay, as one big company. All right. Then we have got a term called non-controlling interest. All right. If the parent company does not own 100% of the subsidiary's equity shares, then the part owned by others is known as the non-controlling interest, formerly known as the minority interest. Okay, so minority shareholders are the ones who are entitled to this non-controlling interest. Okay, this is when the parent company is not owning 100% of the equity shares in the subsidiary. Then we have got a trade investment. A trade investment is one in which the investor, neither a subsidiary, okay, or an associate. Okay, let me just correct here. It's actually the investee. All right. All right. Okay. Yes, I'm sure you are seeing the correction which I have indicated here. That when you're talking of the trade investment, this is where the investee is neither a subsidiary or an associate. Okay, it's neither a subsidiary or an associate. So the proper word there is actually investee, not investor. All right. So how do we account for this trade investment? This one is accounted for using the principles of financial instruments. Okay, that is in terms of Ifrs 9. All right, and it is normally measured at fair value at each reporting date. So we will be using the Ifrs 9 principles. Okay. All right. Ifrs 9. Okay. Although this one is actually outside the scope of this course, all right, we will be giving you the relevant course with regards to financial instruments in the near future. Okay, now let's move on to other pressing issues which we need to cover in this course. All right, now the consolidated statement of financial position, that is the SFP, is the one which we are going to look into. All right, so the purpose of the consolidated statement of financial position is to show all assets and liabilities that are controlled by the parent company, effectively as though it is one big company. So we are now going to look at an example for us to assimilate and understand the underpinnings of this consolidated statement of financial position. Okay, remember the statement of financial position, whether for a single company or for a group, simply follow, follows the same presentation. Okay, they just follow the same presentation criteria. So you need not to worry much about whether the position of assets are going to be different or not. Okay, they are not going to be different. It's just the same statement of financial position, which you know, but the only difference here is that it is now for a consolidated group. Okay, so it is now called consolidated statement of financial position. Why? Because we are now saying, we are now adding up the assets which are held by the company with those which are held by its subsidiaries. Okay, by the end of the day, we want to create one big company. All right, so we are going to add line by line for for the assets as well as for the liabilities. But in terms of presentation, it will be the same way of presenting. We will start with the non-current assets, we list our non-current assets, and then we go to the current assets, and then we totalize the total assets, and then we go to the equities and liabilities, the way we used to do for statement of financial position for a single company. All right, so we need not to be confused with this thing. So let us look at this example. All right, you can pause the video and try the question on your own. Okay, on January 1, 2008, Paraza P standing for parent. Okay, Paraza P acquired 100% of ordinary shares of Shadia S and S. Okay, for the purpose of this example, S will be the subsidiary. So this parent P acquired 100% ordinary shares of Shadia, which was incorporated on that date. So the date in question is 1 January 2008. All right. The following were the two company statements of financial position as at December 31, 2010. So we have got the balance sheet or the statement of financial position for P as well as for S, the subsidiary. So we are having two subsidiary, statements of financial position as presented on the screen. Now the question is saying, prepare a consolidated statement of financial position as at 31 December 2010 for the Parazai group. Okay, now this is very simple. Okay, you mustn't be confused about it, because I say that in consolidating we'll be adding line by line, okay, with the few exceptions which you will understand as we proceed with the lecture. Okay, okay, now I want you to pay very careful attention to issues within this simple example. All right, because in accounting you just have to be very attentive to detail. All right, the statement is saying on the 1st of January, Paraza P acquired 100% of the ordinary shares of Shadia S, which was incorporated on that date. So this statement is just telling us that the date at which the subsidiary was acquired was the date when the subsidiary was actually incorporated. Okay, it's actually a very important fact in consolidation, because there is an aspect of retained earnings. There are rules that govern the addition of retained earnings of a subsidiary to the group. So you need to pay careful attention on when the acquisition took place. Was it when the company was being formed, or way after the company was formed? Okay, all right. So this first example, the subsidiary is being acquired on the date when it was formed. All right. So our addition is going to be very simple with regards to retained earnings. Also, I want you to notice that when P acquired S, it paid some money. Okay, because you don't just acquire once I mean another company for free, you pay something. So P paid $10,000. So this is why it is written investment in S at cost $10,000. Okay, so they paid. So when we do the consolidation, we are not going to add this amount. This one is not going to be added. So our new or group SFP is going to be like this. Okay, so we are going to present the group balance sheet on the far right side. So like I said, in consolidation, it's about adding line by line items. So for the non-current assets, we are going to add 25,000 and 12,000. Okay, and there we get our 37,000. Okay, and like I said, we are not going to add anything. Okay, for the investment, this one is not going to appear in the group account. It only appears in the parent's individual records. But to the group, we are not going to include. We only include its effects. The effects are that there is now control, and this is why we are adding line by line items. Okay, now for the current assets, we do the same. We add, okay, 8,000 plus 9,000. All right, so that's 17,000. All right, so we add up, we get a total of 54,000. We come to the equities and liabilities section. All right, the share capital. The share capital is also bound by certain rules. Okay, now all the companies in the group are owned by one company, that is the parent. Okay, who has got the controlling stake in all those companies. So only the equity shares of the parent is applicable to the group. So we are only going to pick the equity shares, the value of the equity shares of the parent. So this is 25,000. So this is why I said, although in consolidation it is an issue of adding items to items, you will discover that there are certain rules which have to be complied with. This is the importance of accounting standards. All right, you do not have to add the equity of the subsidiary, because the subsidiary there is being controlled by the parent. So only the parent equity matters. Now, on retained earnings, since this subsidiary was acquired on the date of incorporation, it means that there are no pre-acquisition profits. So in this case, we are going to take all the profits of the subsidiary and add them to the parent's profits, and we get the total. So the total here is 23,000 for the retained earnings. And then for the current liabilities, we're also going to add across, and we get 6,000. So we add everything up, we must get the figure of 54,000. So, ladies and gentlemen, that's the first SFP for the group. This was actually a very simple consolidation question. Okay, let's get a little deeper into a situation where we now have pre-acquisition profits. Okay, pre-acquisition profits, these are the profits which have been earned by the subsidiary before it was acquired. Okay, but in this case, Shadia was acquired before it did anything. Okay, before it traded. So it was acquired on the date of incorporation. Okay, the retained earnings were 0. All right, so that is it. So let's move on. Okay, as already been alluded, usually companies acquire other companies after many years of trade. Okay, so when a company acquires another after a period of trade. It could be after months of trade or after years of trade. They are usually what are called pre-acquisition. Pre-acquisition profits. Now, these pre-acquisition profits would have been factored in when the parent was paying for the cost of acquiring that company. All right. So there are certain rules which have to be observed when we are now adding the retained earnings for the group. We need to factor out, or we need to remove those profits which were earned before the acquisition. Why? Because they were not profits which were made by the group, but they were profits which were made before the acquisition. Okay, so it will be a lie to say that we also made those profits when we didn't make them. So that's the idea of pre-acquisition profit. So when you do your consolidations, you need to factor them out. Okay, we'll look at this in an example, but before that, let us look at the issues to do with goodwill on acquisition. Okay, because we might also might be required to show our expertise with regards to goodwill. So we need to define what goodwill is and how does it matter in consolidation. Okay, now in basic terms, goodwill is something related to the image. Okay, the image of the company. Okay, if the company's image to the public is good, usually there is a premium that is associated with its share value. Okay, so usually people end up paying a premium charge, okay, when they acquire that company's shares. Okay, they pay some extra costs. All right, so usually maybe the company has got good image. Okay, it does well with regards to environmental issues, it participates in climate change, something like that. Those are the things which link a company to be a better corporate citizen. All right, so there is an aspect of image or sometimes special skill within its management. Okay, in its management. Okay, the management of the company possess a certain skill which is rare. All right, so that would also force bidders or those people who want to acquire the company to pay some extra cost. So usually goodwill is called, in acquisition circles, goodwill is also called premium on acquisition. Why? Because the acquirer would pay some extra cost. So in many consolidation questions, you are going to be required to calculate goodwill. All right, in our first example, as you can see, we did not calculate goodwill, and there was a reason. Why didn't we calculate goodwill? Somebody might be asking. Okay, and there was a reason. All right, when you look at investment in S, it was at a cost of $10,000, and the share capital of S was also $10,000. So you can see that there was actually no premium charge. There was no goodwill in this case, so the goodwill was zero. Why? Because the investment cost was equal to the value of the shares in S. So there was we actually paid there was no gain on the part of the the owners of S. All right, we just paid what the actual value of S. So there was no premium in this particular acquisition. All right, so there was no goodwill. All right, so there are reasons, like I said, why companies or acquirers end up paying more with regards to acquisitions of subsidiaries, right? And some of them would be that the subsidiary is a company that has got a good image, okay? Over many years of trade, they have got a good image which they command, and that actually link them to receive better bids. All right. Okay. Perhaps we need to go a little deeper to understand the accounting of this goodwill. How is it accounted for? Okay. Firstly, in the books of the parent company on consolidation with subsidiary Acca, the following entries are made. We are going to debit the investment in subsidiary with the cost of that subsidiary. Okay, that's a debit. All right, and then a credit because we are giving out money, so therefore we are going to credit the bank. But in the group accounts, we are going to debit only goodwill. This is why I said we are not going to debit the investment in the subsidiary. Why? Because only the impact matters. All right, so the impact was that we are going to consolidate line by line. All right, and then we are also going to have to debit an intangible asset. Okay, goodwill. This is an intangible asset. We are going to say, like, we can't actually touch the image of the company or the skills of its management. We can't touch them physically. So it's an intangible asset. All right, then we are also going to credit the bank or consideration that has been transferred. All right, let's move on to the next aspect. Now, what if the consideration is negative? We have said that we are going to debit the goodwill. Remember, an asset is something that is a positive figure, okay? Now, what if in our computation for goodwill we determine that the figure is negative? Okay, ladies and gentlemen, here is the thing. One might be wondering, how can it become negative and how can it become positive? All right, ladies and gentlemen, this is the formula for calculating goodwill. Okay, we are also going to touch on this formula when we do the real example. All right, we are saying to calculate goodwill, you just have to say consideration transferred. It's actually fair value of consideration transferred. Okay, all right, and then less. That is if you acquired 100% of the subsidiary. All right, so fair value of consideration transferred less net assets of subsidiary. Net assets of subsidiary, and you get your goodwill. All right, and when we are talking of net assets, right, net assets are actually all right, let me just say right on this portion, net assets are the share capital of the sub, as well as the retained earnings of the subsidiary. Those are the main components of net assets of the subsidiary. we've got the share capital and the retained earnings. All right. Now, in the case of our first example, let me take you to the first example. The first example was having all right, the consideration. Let us work with this example. The consideration transferred was how much? Sorry, the consideration transferred was 10,000. All right, the cost was 10,000. So we slot in that figure here, 10,000. All right, and this was 100% subsidiary. So we just come straight to less net assets. And I said net assets are share capital. The share capital was how much? The share capital was 10,000. The share capital of this subsidiary was 10,000. We put it in bracket. And then the retained earnings. The retained earnings of this subsidiary. This subsidiary was acquired before it traded. So there was zero in terms of net assets. So, I mean, in terms of retained earnings. So there was a zero there. So when we do our computation, you can see that 10,000 minus 10,000 minus 0, we're going to have a 0. So this is why I said goodwill here was 0. Why? The cost was equal to the net asset. The consideration transferred was equal to the net asset. So the goodwill there was 0. All right. But now, it might happen that when you do these computations, you discover that the goodwill, all right, could be positive. When it is positive, then you have got an intangible asset. How can this be positive? Let us suppose, in this case, let us suppose here, okay, what's going on? All right, I was looking for the rubber. All right, let us say the net assets here are of a lesser amount. Let's say the share capital was 8,000. Suppose the share capital was 8,000, all right, and the retained earnings was 0. No problem. All right, so you can see in this case, then the net assets are lower in total than the consideration transferred. So we are going to have a goodwill of $2,000, which is positive. All right. So in this case, we are having an intangible asset in the group account. Intangible asset. But we are saying now, sometimes you will discover that the working would become negative. Okay, all right. Let us say, using the same structure, our share capital is now, let's say the share capital this time is okay. The share capital is in this case 12,000. If the share capital is 12,000, it means we are now having goodwill, which is negative, minus 2,000. So it ceases, it won't be an intangible asset. There is a way of dealing with that situation. All right. So in that case, we treat that as a gain. Okay. It then means that we have made a gain on acquisition. All right. Now, how does it become a gain? Okay, it simply means that we would have paid less during the acquisition. We paid less than the value of the acquired company. The company worth more, but we paid less. Okay, the subsidiary would be worth more. More dollars but we ended up paying less. So there has been a gain or bargain purchase. When we did the acquisition, then we made some gain. So the entry that is applicable is we are going to credit the P&L, we're going to credit the profit or loss, and at the same time, we'll be debiting the investment in S. All right? So as usual, we're going to debit the investment in S and then credit the P&L or retained earnings. Most likely reason for negative goodwill is a misstatement of the fair values of assets and liabilities. So the standard requires, therefore, that the goodwill calculation is reviewed to ensure that the correct fair values have been included. We could have made some mistakes somewhere. So after such a review, any negative goodwill remaining is credited directly to the statement of profit and loss or retained earnings, that is working 5 if we are following the standard Acca computation model. Okay. Now we are going to discuss about this in a short while, but let's talk about this other aspect. Okay, the non-controlling interest. It's a very important area. Now, non-controlling interest. When a parent entity controls a subsidiary, it usually does so because it has voting rights, that is, owning more than 50% of the voting share capital. It is possible that it does not own all the shares, implying that there are additional minority shareholders. These are referred to as non-controlling interest. For example, if a parent owns 70% of the equity ordinary share capital, it is likely to have control because it controls the majority of the voting rights unless proven otherwise. Okay, this qualification is given because the standard also recognizes some contractual relationships that would be at play behind the scenes, where you will see that some shareholders, they own more than 50%, but they still are considered minority shareholders. Why? Because there could be some contracts that limit their control. All right. Now, the non-controlling interest owns the remaining 30% of the company. Okay. The non-controlling interest has a financial and voting interest in the subsidiary, but does not have control over it. That is done by the controlling parent. However, for the purposes of basic consolidation, we are only going to assume that when one owns more than 50% of the shares in a subsidiary, then that person has got control, has got enough control to exercise, to dictate the amount of variable returns they are going to get. Okay, so they will be having enough control. They'll be having enough power to exercise their control. Okay, now let us look at the mechanics of consolidation. Here we are looking at the standard workings. Standard workings. All right, especially to those who are studying the Acca paper, financial reporting, or the financial accounting paper, they would find these workings useful. All right, so let us look at what they are. There is usually what is called working number one. It's a standard working number one, which you need to accustom yourself with. Okay, so whenever you are given a consolidation question, you need to bear in mind that working number one is very essential. Here you are just required to establish the group structure. You are given the fact, so you need to come up with the group structure, some sort of drawing. Okay, so we are saying you need to tell yourself which company is the parent and which one is the subsidiary. How much have been acquired? How much in terms of equity capital has been acquired by the parent. So you might establish that 70% has been acquired. At what date? You need to ensure that you know that date. On 1 January, for example, 20x3. Okay, thus you need to have that idea. All right, so you need to identify the percentage shareholding of the parent and the non-controlling interest and the date the shares were acquired. So you can see that the controlling shareholders are owning 70%, and then the NCI are owning 30% of the equity capital. Now you move on to the net assets of subsidiary. So far we had identified the two main components, which were equity share capital and the retained earnings. However, you will discover that the share capital normally moves hand in hand with its share premium account. Okay, the premium is the extra amount that is attached to the shares from its nominal value. Remember, the equity share capital or the ordinary share capital would be the nominal share value. This is the nominal according to the Kanban records. Usually the Kanban articles of association or memorandum of association would detail, or the Kanban constitution would detail the nominal value of the shares. Sometimes these shares will be 25 cents each, or it would be $1 each. That's the nominal value. However, because of the appreciation of share value over time, you will discover that when these shares are now issued to the public, they would be fetching more money from more on top of the nominal. So usually when the company offers these shares to the public, even if the record is saying that they are worth $1 each, the company would sell those shares maybe for $5 each, and the extra $4 would be the share premium. Okay, that's the share premium for you. Also, there could be some revaluation surplus. Revaluation is attached to assets, non-current assets, in terms of IAS 16, where if the company follows a revaluation model, then it means that the assets could be appreciating in value. Okay, they are being revalued at the year end, or usually, or maybe frequently, or regularly over during the year. They appreciate in value. So that appreciation, okay, or that extra value accumulated becomes the revaluation surplus. All right, so it's also part of the net assets component. All right, so when you are required to compute the value of net assets, you then have to know that there are a lot of adjustments which might be required to be done first before you do any further calculation. So these are just a minimum. Okay, there are many, right? You might also be required to factor in the fair value adjustments at the date of acquisition. All right, so we are given 2 dates there. There are 2 dates. There is excuse me, something is happening with my pen here. There is the date of acquisition, okay, date of acquisition, as well as the date for reporting, okay, or the reporting date. All right, now in consolidation, okay, or in consolidated financial statements, you need to know the date at which the company has been acquired, as I've indicated on working number 1 there, the date of acquisition, as well as the date of reporting. All right, now this is important because between the 2 dates there is a movement in value, okay, which has to be incorporated when you do further workings. So the total of issued share capital and share premium from the subsidiary. statement of financial position should be unchanged at both the date of acquisition and the reporting date. This is the assumption at this level, that there were no changes. But in real life, there could be changes because shares could be issued further to the public and so forth. But for the purpose of basic consolidation problems, we just have to assume that these were just as constant from the date of acquisition. All right, so that's it for this fact. So like I said, there is usually going to be a movement between the two. Okay, there is a movement which has to be accounted for between the two dates. That movement has to be accounted for appropriately. Okay, let's look at working number 3. Working number 3 is about the goodwill. All right, I've given you a basic formula or template for goodwill where the subsidiary is 100% subsidiary, but we have determined also that the subsidiary could be of another percentage, like for example 70% or 80% subsidiary. Okay, so in that case there would be something called the non-controlling interest. So we need then to factor in the non-controlling interest in our formula. So the formula now becomes fair value of consideration paid plus the fair value of non-controlling interest at acquisition. Why are we saying we need to add the fair value of non-controlling interest? This is because we are saying when we paid the consideration to acquire this particular company, there were also owners. Okay, they are also owners who are also attached to part of that company. Okay, although they do not form part of the controlling interest, in terms of the valuation of the acquisition, they are also important. All right, so for us to determine the amount of goodwill within the company, we also have to factor the value of that non-controlling interest. All right, so the value of the non-controlling interest, we also need it. It should be the fair value of that non-controlling interest, as well as the fair value of the actual amount which we paid. All right, then we deduct the fair value of net assets. All right, remember this is the formula for goodwill using the full goodwill method. This is the full goodwill method, and this is the method we are going to focus on for the purpose of this lecture, where we'll dedicate the goodwill computation in a separate lecture. Okay, we'll dedicate that one in a separate lecture. But for us to understand the basics of consolidations, we just have to move with the full goodwill method. All right, so we then have to deduct the fair value of net assets, and this one has been done in the previous working. Okay, this is what we did here. Right, so this was the fair value of the net asset. Remember, this is the fair value of net assets. Those are the totals for the fair value of the net asset. All right, then we did the goodwill, and that's how you obtain it. And like I said, if it is positive, it means it is an intangible asset. If it is negative, then it means that you have made a gain, and you just have to take that goodwill straight away to the profit or loss statement as a gain. Okay, gain on acquisition. All right. Now, what about working number 4, the non-controlling interest? Here we start with the fair value of non-controlling interest as in working 3. Okay, so which means this figure, okay, this figure should actually be the same as this figure. All right. So if you confuse these figures, if they are different, the examiners would easily see that you do not know what you are doing. All right. And then you need to add the non-controlling interest share of post-acquisition reserves. Okay. Remember, I said that you need to be careful, because how do you see these post-acquisition reserves? You need to visit your working number 2. Your working number 2, and we talked about this working number 2, and we say that it is very, very important. All right, I say that there is a movement which has to be accounted for between these two periods. That movement is what we are talking about. Okay, that movement. All right, so if there has been a movement in the reserves we are talking about, these are the reserves. These are normally the reserves. We are talking about the revaluation surplus, the retained earnings, and so forth. So if there has been some movement, remember, we assume that these ones will remain constant. I mean, these first two, the first two are going to be to remain constant. All right, the first two are usually not going to change. All right, even in real life, they normally don't change. But the revaluation surplus and retained earnings, these ones are the ones that change quite often. So whatever movement that is going to happen is the one that we need to account for, to factor in when we do our computations for non-controlling interest. So the share, now, if it is, for example, a 30% NCI, then we are going to say 30% multiplied by the movement in reserves. The total movement could be maybe 600,000. So we multiply by 600,000 and we get the share that is attributable to the NCI. That's the one we are going to add there, and we get the total NCI figure. It's so simple, isn't it? Then you move on to the last part. Now, the NCI and the retained earnings, they are somehow related in the way they are being done. Okay, we also start with the parent's earnings, retained earnings. We take 100% of the retained earnings from the the parent's balance sheet. We take 100% of the retained earnings, and then we add the parent's post acquisition, okay, parent's percentage of the subsidiary's post acquisition retained earnings. So if we acquired the subsidiary with 0 retained earnings, and then they did business, okay, and their retained earnings were 100,000, we are going to take the percentage. If the subsidiary was a 70% subsidiary, we are going to take 70% of those post-acquisition retained. Remember, these are post-acquisition. If the subsidiary had its pre-acquisition retained earnings, we just have to first deduct those pre-acquisition retained earnings, and then we factor in our percentage of shareholding, that is 70%, okay, and then we get our share. All right, I think we have spoken too much. It is now time to do the full example. All right, let us look at this example, ladies and gentlemen, to see if we can make sense out of this presentation. Okay, P purchased 60% of S shares on January 1, 2007, when S obtained earnings were $6,000. At the time of acquisition, the non-controlling interest had a fair value of $30,000. On December 31, 2010, the following were the two companies' statements of financial position. So, as usual, we are given two balance sheets there on the same page. All right. Now, non-current assets were 50,000, 30,000, investment in S at cost 40,000, current assets 14,000, 12,000, share capital $1 shares, that's the nominal value of the shares, $50,000 and 20,000 for S, retained earnings 44,000, 16,000, current liabilities 10,000 and 6,000. We are required to prepare the consolidated statement of financial position as at 31 December 2010. So you need to be able to gather the fact when S was acquired, it already had retained earnings of 6,000. Okay, and the non-controlling interest at acquisition was 30,000. All right. So at this particular year end, okay, at 31 December 2010, those were the two statements of financial position. All right. Now, for us to calculate or to prepare the consolidated statement of financial position, we need to follow the standard working. And like I said, you start with your group structure. Okay, the group structure working number one is very simple. All right. We are told that they acquired 60%. Okay, that's 60%. So, and the date was 1 January 20x7. So we know that P acquired S, okay, 60%. All right. So therefore, the NCI is 40%. Simple one. Then the acquisition date is 1 January 20x7. All right, that's what we know. Okay, that's the general structure of the group. Then we then move on to working number two. Okay, working number two. You can just fuse the working number 2 and 3 on one. Okay, because in the examination you do not have time to dilly-dally or to do a lot of these cosmetics. All right, in the exam you'll be under pressure, and usually in the modern day the examination is actually a computer-based examination whereby the requirement for the group structure is no longer the standard. Okay, you just have to know by your head that that's the structure. Okay, you can just note it down as I've done there. Just have to note it down like acquisition date is 1 January, and then the relationship is 60%, NCI 40%, and so forth. All right. Then, how do we calculate goodwill? We say that you need to understand the fair value of the consideration transferred. And in this case, according to the balance sheet given, it was $40,000. Okay. Now, the fair value of the non-controlling interest, the fair value was given in the question as $30,000. So we add up that and we get a total of 70,000, and then we need to then deduct the net assets. Remember, these are the net assets. Our net assets, these include the share capital of the subsidiary. From the question, as you can see, the share capital of the subsidiary was this much and the retained earnings with that. So you just have to do what you must do. Now, the share capital was 20,000. But now for the for the retained earnings, we then have to factor in, okay, we need to deduct the pre-acquisition retained earnings. All right. So if we go back, the pre-acquisition retained earnings were 6,000. All right. All right. And the retained earnings at reporting, at acquisition for the subsidiary were 6,000 as given, but at reporting they were now 16,000. Here we are calculating goodwill at acquisition. Okay, goodwill at acquisition. So this figure here is not yet relevant. Okay, so we still have to consider using the retained earnings at acquisition. Okay, so the retained earnings at the acquisition were 6,000. All right, now we add them up and we get your 26, and then we need to deduct this 26 from the 70, from this figure, from 70, and we must get the goodwill on acquisition or at acquisition of 44,000. All right, now once you did that, you go to working number 4. Your working number 4 is for the non-controlling interest. All right, so here you need to start with the fair value of non-controlling interest at acquisition, and this should be the same figure as with working number 2. I mean working number 3. So 30,000, 30,000. Then the NCI share of post-acquisition profits. Okay, now we have determined the non-controlling interest at the date of acquisition. We then have to also consider the non-controlling interest share of post-acquisition profits. All right, so we are told that this subsidiary made profits, had accumulated profits of 16,000 at the reporting date. Okay, they were now 16,000. Okay, now if they are now 16,000, it means they have moved from 6,000 to 16,000 by how much? By 10,000. Okay, so they've moved by 10,000. This is the 10,000 we are talking about. 16,000 minus 6,000, and that's 10,000. Multiply by 40%, because our NCI, remember, is 40%. So that's 40% multiplied by 10,000, and we get 4,000. So the total NCI is now 34,000. We move on, okay, to working number 5. Working number 5 is about the retained earnings. Okay, the retained earnings. We know that the retained earnings of P at the reporting date were 44,000. Like I said, we take 100% of the parent's retained earnings. Okay, so at 31 December 2010, the retained earnings of P were 44,000. But then I have to add the post-acquisition. Okay, the subsidiary's post-acquisition profits. All right, for us to do that, we know that the subsidiaries retained profits at the reporting date were now 16,000. However, we need to deduct the pre-acquisition, okay, the pre-acquisition profits, which were 6,000, and so we need to account for 10,000. However, we are not going to take the whole 10,000. We only have to take our own share, that is 60% of that. So this is why we are only going to take 6,000, and our retained earnings are coming to 50,000. Then for the statement of financial position, it's now going to be very easy. Okay, so we can just do this on the space given. Okay, let us just do it on this space so that our understanding is not going to be disturbed. So the group SFP, we are going to add across the non-current assets. These ones now, that's 50,000 plus 30,000. We are going to get 80,000. Okay, that's 80. All right, like I said, investment in S for the group, we're not going to put it as start as such. We ignore it, okay, because for the group it's irrelevant, because we only want the impact. We are only going to account for the goodwill. All right, so we're going to say, instead of actually having this line for the group, we're going to have the goodwill. And we have calculated the goodwill on acquisition on working number 3, and we determined that this was 44,000. So we just take the goodwill 44,000. Then the current assets, these ones we add, okay, and we get 26, if I'm not mistaken, there 26,000, and then we total up, that's 150,000. We go to the equities and liabilities section. Like I said, we take 100% only of the parent, so that's 50,000. Then the retained earnings, we have calculated the retained earnings. Don't make a mistake of just adding across the reserves and share capital. Please, they are not, they are restricted by certain rules. Okay, so don't make a mistake of adding the retained earnings there. Only the current liabilities will be added across. Okay, so this one here is just 16,000. But for the retained earnings, we did the computation. Okay, we did the computation for the retained earnings. We also have another working there, which we need also to incorporate for the NCI, the non-controlling interest, which was working number 4. Okay, you need to factor in that. So there are two figures there we need to slot in so that our workings are true and fair. Okay, so let's start with the retained earnings. The figure was how much? The retained earnings working number 5, this was 50,000. So we slot in the retained earnings as 50,000. Okay, and then we also have to slot in the non-controlling interest working, which was working number 4. Okay, working number 4, and that was 34,000. Please make sure you replay this video until you understand where we are coming from and where we are going. So if you add up those figures, you must arrive at 150,000, and you be satisfied that your balance sheet has balanced. Okay, now let's move on to another interesting area, which I have found very, very, very challenging. Okay, this area I've determined it to be a challenging area. The types of consideration transferred. It is not only cash that is going to be transferred. Okay, sometimes these considerations are done on a share-for-share exchange. Sometimes they are done on cash. Sometimes they are done using different things. Okay, you need to understand the valuation tactics that will be employed. All right, so for the purpose of this course, we are only going to look at another consideration. Okay, we are only going to look at two: the cash consideration as well as the share. Sometimes you'll be given shares instead of cash, so that will be a share for share exchange. Okay, this point is very, very, very important. This is a very important statement. The calculation of goodwill must be based on the fair value of the consideration transfer. For cash, this is straightforward. It is simply the amount of cash paid. But what about for shares? This will be the fair value of shares. Okay, that is the market price at which the shares are going. All right, at the date of the acquisition. The market price or the market value of those shares. Right, so let's try this example and see if we understand this concept. All right, here we are looking at an example where the consideration is in the form of shares. Prestige company. All right, Prestige company has acquired all the share capital of Sunstone company, $12,001 shares, by issuing 5 of its $1 shares for every 4 shares in Santam. The market value of Prestige Company's shares was $6 at the date of acquisition. The fair value of Santam's net assets at the date of acquisition was $75,000. You are required to calculate the goodwill. Okay, now let's determine the fair value of the consideration transferred. Let us use the spaces available. Fair value of consideration. All right. Now, how many shares we acquired? 12,000 shares we acquired. Okay, by issuing 5 for 4, so that's 5 over 4. Okay, and the nominal value, okay, the nominal value of the shares is $1. Okay, it's $1. All right. However, the market value is $6. We say that if we are using the shares as a means of consideration, therefore the shares have to be valued at their market price, and the market price is $6. So we just say multiply by $6, and we must get 90,000. $90,000. Now, once we have determined that, we then have to determine the share capital and share premium component. Why are we thinking of the share premium? Because the shares are issued at the market value when their nominal value was $1. Okay, so it means that there has been a share premium. Okay, so the share premium is how much? Share premium is $6 minus $1. Okay, which is equal to $5. So the share premium is $5 per share. $5 per share. All right. So the share capital component is, we know that the share capital or the owner share capital is $1 each. Okay, so let's determine the share capital. All right. Okay, so this one is going to be very easy. Okay, because we know that the share capital is $1 and the number of shares issued were 12,000. All right, so this is 12,000 multiplied by 5 over 4. Okay, multiplied by $1. So 12,000 over 4 or 12,000 multiplied by 5, this is going to give us 60, and 60 over 4, that's 15,000. So we get 15,000. All right, and then we also have to determine. So it's very simple. Okay, in the exam under pressure, you know that the total of these two figures should be 90,000. All right, the total of both the share capital and the share premium, because these ones are the components of the consideration which was transferred. It included both the share capital and the share premium. All right, so by the end of the day, they should add up to $90,000. So we know that the balancing figure there should actually be 75,000. But you can do the mathematics and determine that figure. The figure can also be determined by, we know that there were 12,000 shares which were acquired, multiplied by 5 over 4, multiplied by the share premium, which we determined to be $5. We know that the share premium is $5. Remember, okay, share premium is $5. So if you punch these figures, 12,000 multiplied by 5 over 4 multiplied by $5, you must get $75,000. Okay, so that's how we obtain the share premium component. So remember, the double entry that has to be done is we need to debit in the books of Prestige, the parent. We debit the investment in Santon, which was 90,000. That was the cost of the investment. The consideration transferred, remember, we calculated it there, 90,000. Then we credit two things here. We credit the share capital. How much? 15,000. And also credit the share premium, 75,000. Remember, the double entry has to have both the debit and credit side balancing. Okay, now let's finish up our computation. That was the fair value of consideration, which we have been doing. Now the net assets, and let's determine the net assets of the subsidiary. Okay, so then the net assets includes the share capital and the share premium. All right. Okay. We are saying it includes the share capital, share premium, retained earnings, revaluation, surpluses, and so forth. Okay, but all these have been given by the examiner as 75,000. At the date of acquisition, they were 75,000. All right, so obviously, if you deduct the 75,000 from the fair value of consideration, which was 90,000, so we are going to have goodwill of $15,000. So it is very important for you to be very analytical, at the same time attentive to detail, because you might end up confusing yourself. After all these computations, you might find out that you have lost your way. So the very important attribute required of you is to be very attentive to detail. Okay, now let's look at other pressing issues. Intra-entity trading. Types of intra-group trading. Now, P&Ls may well trade with each other, leading to the following potential issues to be dealt with. So you discover that the subsidiary might be trading with the parent along the way. Okay, so a lot of things might emanate. For example, we will have to deal with receivables and payables in P and S that effectively cancel each other. These are normally called current accounts. Then dividends paid by the subsidiary recognized as income by the parent. Similarly, if a dividend is paid by one entity and received by the other, the net effect of this to the group is zero. So because these companies are under same control, so if one company pays dividend to another, therefore the effect is zero. Okay, because the left hand can't say I've given the right hand something, when they belong to the same body, so there is no gain or loss that has happened there. Unrealized profits on sales of inventory between the parent and the subsidiary. The important question is, can you make a profit if your right hand sells goods to your left hand? Obviously no. No profit would have been made. Okay, so a group cannot make profit when one part of it sells goods to another part. All right, let's look at this more mature example. It's going to take much of our time, but we're gonna do it quickly. Okay, Pico acquired all the shares in ESCO 1 year ago when the retained earnings of ESCO stood at 10,000. Draft statements of financial position for each company are as follows. So we have got PCO and SCO. Let me just draw a demarcation line here so that we understand what will be going on. All right. So the non-current assets and tangible assets are 80,000, and investment in SCO is 46,000, giving us a total of 126,000. Then we've got current assets, 30 plus 10, that gives us 40,000. So the total assets were 160,000 for PCO. The same can be said for SCO, which is having total assets of 70,000. Okay, then the equities and liabilities section of PCO was having equity ordinary shares, $1 each of 100,000, and retained earnings of 45,000, giving us a total of $145,000. Trade payables were 21,000. Oh, if we add them up, they give us a total of 166,000, and if we come this side, we also get a total of 70,000. Now, during the year, SCO sold goods to PCO for $50,000. The profit to SCO being 20% of selling price. At the period end, 25% of these goods remained unsold in the inventories of PCO. At the same date, PCO owed SCO 12,000 for the goods bought, and this debt is included in the trade payables of PCO and the trade receivables of SCO. You are required to prepare a draft consolidated statement of financial position for PCO. Okay, so we know that the profit we are going to be worried about is the profit that was made on goods which are still in stock. Okay, when one company sold goods to another company, they included some profit element in their transfer, okay, in the form maybe of transfer pricing. Okay, so there was some profit element of 20% of the selling price. But our worry would be on the profit element on goods which are still in stock. If the goods were sold to another company and they were then by the end of the year were sold to the public, then we could actually say for that portion of the goods which were ultimately sold out of the group, then the profit was really made. But if some of the goods are still within one of the companies, then that profit has to be cancelled out because it is not profit at all. All right, so let's do our working. Like I said, it's a bit complex, but with a step-by-step approach, we are going to be there. So the first thing we can do here is to calculate the goodwill. So let's do the goodwill computation. All right, so working one, goodwill. Now, the fair value of consideration transferred can have two columns here. This was 46,000. Okay, and then we can just deduct the net assets at acquisition. All right, the net assets at acquisition. Okay, share capital. From the question, assuming that this one do not change, okay, the share capital did not change, we can assume that this value, still apply. 30,000, okay, for S, 30,000 there, still apply. All right, and then we are also told that the retained earnings stood at $10,000 at the date of acquisition. So these are the two figures we are going to use, 30,000 and the 10,000 for retained earnings. All right, so we come here and we say share capital was 30,000. All right, and the retained earnings were 10,000 at the date of acquisition. All right, so we add up, we get our 40,000. Then we less this from the fair value of the consolidation transferred, and we get 6,000. This should be the goodwill. Okay, we then have to worry about the provision for unrealized profit. Okay, because we are saying if the goods are not yet sold, if the goods which were sold by another company under the same control to a company which is also under the same control, then if the goods are still in stock, then no profit has been realized. So let's calculate the provision for unrealized profit. Okay, we are told that they sell these goods at 20% of the selling price. That's which is the profit element. So the profit is 20% of the selling price, and the goods were sold at a sales value of 50,000. So therefore, the profit element in these goods was 10,000. That's 20% of 50,000. Okay, and then the unrealized portion is only on that portion which was not sold. Okay, and we are told that 25% of these goods was still in stock, was still unsold. So in the inventory of PICO. Remember, these goods were sold by the subsidiary to the parent. So we are going to say okay. So we are saying the provision for unrealized profit, we first have to calculate the whole profit that was expected when the sales were made. Okay, and we are told that they were charging 20% of the selling price as their profit. Okay, so the profit element was 20% of the selling price, which means the 40% of the selling price is the cost. Right? So 10,000 was the expected total profit. However, we are told that 25% of the goods were yet to be sold. So 25% of 10,000 is the amount that is unrealized. So that's the amount we need to get rid of. Okay. Why? Because the 75% has been ultimately sold out to the public. So the profit in respect of the 75% of the goods was now realized. Here we only want to cancel out that profit element which is unrealized. Then another important working here, I think, is the retained earnings. Let's do the retained earnings. Okay, why? Somebody might be wondering, what about the non-controlling interest? Do you think the non-controlling interest working is relevant here? Obviously, it is not, because this is 100% subsidiary. Okay, because they acquired all the shares in S-Corp. So to talk about the retained earnings working, this time it is irrelevant. I mean the non-controlling interest working. So let's move on to the retained earnings. All right, now like I said, we need to take 100% of the parent. Okay, so we can just say per question, as per the question. Okay, we have got the parent here, we have got the sub there. We're going to take 100% of the parent's retained earnings at the reporting date. How much were they at the reporting date? These were, according to the question, they were 45,000. All right, and for the subsidiary at reporting, they were 22,000. So let's try to use those two figures. So we are saying there were 40, sorry, that pen is not visible. 45,000 for the parent, and for the subsidiary, 22,000. Hang on, don't worry. And then we need to adjust now. Okay, we need to adjust for the pre-acquisition. Okay, because I know some of you were now wondering. Now, the pre-acquisition retained earnings, we're told that when we acquired this company, the pre-acquisition retained earnings were they were 10,000. If you still remember here, or we can go straight to the question. Okay, you can see that there were 10,000 retained earnings to worry about. Okay, so we factor out those ones. Let us factor out those ones in our computation. So we come here and say 10,000 should go. Okay, and then we also have to adjust for the unrealized profit. The unrealized profit is has to be deducted. All right, this has to be deducted from the subsidiary. We can't say the subsidiary had bad profit there. Why? Because it sold to the parent, which is also a company under the same control. Okay, so we can see that the subsidiary has ultimately made retained earnings of 9,500 as at reporting date. All right, now we then have to ask ourselves, how much must the group take from this subsidiary? Because this one is 100% subsidiary, so everything has to be taken. So we are going to say here group share. The group share obviously is going to take the whole 9,500. So 9,500, right? Why? Because ESCO is 100% subsidiary. But if it wasn't 100% subsidiary, then we were going to consider, we're going to take the group portion. If it was an 80% subsidiary, then we're going to take 80%. And then we would also have to worry about the non-controlling interest issues. However, because this one is 100% subsidiary, we do not have to worry about all those things. So we take the 100% of the share. And we get group retained earnings, group RE of 54,500. Okay, now we have done the retained earnings, we have done the provision for unrealized profit, we've done the goodwill. Then what is stopping us from doing the full SFP? Okay, because of my space, I'm going to start here. So remember, when you do your statement of financial position, you have to put the name of the group company. So this is PCO Group. PCO Group statement of financial position as at this one is as at is it 31 December 2010. Let us from the question has to guide us. Okay, here the date is not important. All right, so you just have to put the date, for example, as at 31 December 2022. All right, this is what is required by IS1, presentation of financial statements. All right, but now you need to know that this is a consolidated. So PICO group consolidated statement of financial position as at 31 December 2022. All right, then what you need to do then is to start with your assets. You start with your assets. All right, and in these assets we've got non-current assets. Non-current assets. These are tangible and intangible. Okay. The intangible, we've got goodwill so far. All right, so we can also have our two columns, the dollar signs. All right, so the tangible assets, our tangible assets, according to the question, if we add them across, we can see that we have got 80,000, got 80,000 there, plus the 40,000, that gives us 120. So we come here and say 120 as our tangible. Then intangible, goodwill, we have calculated this as our working, this time it was working number one. Okay, working number one, we determined that it was 6,000. Okay, if you still remember, that's 6,000. So we come here and we slot in the figure 6,000. I hope the red pen is visible. Then we go on to, we can total up these and they give us 126,000. Okay, other people are complaining and say, oh no, it's not visible. Okay, let me return back to my black pen. All right, let's do the current assets. Okay, the non-current assets, let me underline them. Now, the current assets, according to the question, sorry. Okay, the current assets, we have got trade receivables and inventories. Okay, so we're going to add this and that. All right, so 30 plus 25,000. But we are also going to worry about the current accounts. At the same date, we are told here, at the same date, PICO owed $12,000 for goods bought, and this debt is included in trade payables. So we are going to remove the 12,000. Okay, we're going to remove the 12,000 here. So we're going to say minus 12,000 there. All right. We are also going to remove in the payables here, the payables, we're going to say minus 12,000. All right, so let's do that. Let's do that. Take my black pen. Okay, and say for the current assets, we are going to say trade receivables. We are going to say 30,000 plus 25,000 minus 12,000. Let me just write them below. Okay, 30,000 plus 25,000 minus 12,000, and this gives me 43,000. Then we have got inventories. Okay, the inventories, ladies and gentlemen, we are also going to add them across, but we also need to think of the profit element attached to these inventories, which has to be removed. Because remember, when the subsidiary was charging to the parent, it put the profit element, which was unrealized, on top of the cost of the inventory. So that cost has to be removed. That value element on the inventories has to be removed. So we are going to say, if we go back to our question, we are having here inventories, the inventory values. Okay, the inventory, we said 10,000 plus 5,000. We then have to deduct the profit element of 2,500. Are we clear there? Okay, is that clear, ladies and gentlemen? Yes, I hope we are together. So let's move. So we come here to our answer sheet. Sorry. Okay, so we are going to say inventory for the parent was 10,000 plus that one for the subsidiary, which was 5,000, minus the unrealized profit element, which is a cost to be deducted, and we get 12,500. It is good practice in an exam to indicate the working number. For example, you can just say working number 2, so that the examiner will see where you are getting the 2,500 from. Okay, then you total up. Let's total up our current assets. That's 55,500. Then we add up that column and we get 181,500. This is our total assets. Total assets for the whole group. Now let's attempt the equities and liabilities side. Okay, for the equities and liabilities side, we are going to squeeze. So we are going to say equities and liabilities. So we start with the equity. Okay. Now the equity is the share capital. All right, the share capital and retained earnings. So we're gonna say ordinary share capital, and we just take 100% of the parent. The parent's figure was 100,000, so we just slot in the 100,000, and then the retained earnings according to our calculation, that is working number 3. Our working number 3 was saying that the retained earnings were 54,500, so we just have to slot in that figure, 54,500. Okay, and then we go to the liabilities. All right, and we only have got current liabilities, so we can just say on liabilities, you just have to say current liabilities. All right, which we have got trade payables, and the trade payables, we have got 21,000 for the parent plus 18,000 for the subsidiary minus the 12,000. The 12,000, remember, as we deducted this 12,000 on receivables, we also have to deduct it on payables. Why? Because these current accounts are canceling one another. Okay, so we get total current liabilities of 27,000. So if you add up these figures, if you add them up, they must give you a total of 181,500 as your total for equities and liabilities. Okay. All right. Just forgive me for trying to squeeze up things and so forth. All right. But I hope we are together there. So we have touched aspects to do with intra-group trading. All right. And also current accounts. I think we can just add a few notes on that one, on intra-group trading and NCI. Where a subsidiary company which is not wholly owned is involved in intra-group trading within the group, a further problem occurs. For example, PICO owns 75% of the equity of ESCO. ESCO sells goods to PICO for $20,000, that is $16,000 cost plus $4,000 profit. If these items are unsold by PICO at the period end, then there will be unrealized profit of $4,000 earned by ESCO and charged to PICO. From the group perspective, the whole of the unrealized profit must be eliminated on consolidation. If the profit was made by the subsidiary, the NCI are charged with their share of the unrealized profit. To account for this in the group account, we remove the whole profit, charging the NCI with their portion. So what are we going to do? We are going to debit group retained earnings and debit the NCI, that is to reduce the NCI, and then credit group inventory, that is the statement of financial position. We have actually done this. However, the problem we just solved did not have the NCI, but you will see that it is just the same trick we will be doing. So you need to know from whom were the goods sold. If they were sold by the subsidiary, then the NCI of the subsidiary is to be affected. But if they were sold by the parent, then the retained earnings of the parent are going to be affected. So simple, isn't it? All right. Also note that the adjustment to the NCI only occurs where the sale is from the subsidiary to the parent, where the unrealized profit is in the subsidiary. If the sale was from the parent, then there is no adjustment to the NCI. I've already pointed out that. What about acquisitions which are made media? If a parent entity acquires a subsidiary media, okay, there are rules. The net assets must be calculated at the date of acquisition. The net assets at acquisition can be calculated as the net assets at the start of the subsidiary's financial year plus the retained earnings for part of the year up to the date of acquisition, together with any fair value adjustments at the date of acquisition. To calculate this, it is normally assumed that as profits after tax have been accrued evenly throughout the year. So that's the assumption you should make. Now, let's look at example Cody. Cody acquired 60% of Solace on 1 May 27, paying $76,000 cash. The summarized statements of financial position of the two entities at 30 November 27 were with non-current assets there: property, plant, and equipment 130,000, 115,000, investment 90,000, current assets, inventory, receivables, cash, equities and liabilities, we've got share capital, shared earnings. All right. I think this continues. Yes. With recurring liabilities 33,000, 43,000. All right. Now, the following information is relevant. At 30 November 27, the inventory of S included goods purchased at a cost of 8,000 from K, which is the parent, at cost plus 25%. None of the goods had been sold on by S by the reporting date. The K group values the non-controlling interest using the fair value method. At the date of acquisition, the fair value of the 40% non-controlling interest was 50,000, as and a profit after tax for the year of 9,000 in the year ended 3rd November 2007. Calculate group retained earnings of K Group as at 3rd November 2007. Prepare the consolidated statement of financial position of K Group based upon the preceding illustration as at 30 November 2007. So, ladies and gentlemen, let us do this question. Okay, you can just pause the video and do it on your own, and then flow with me. All right. So as you'll be reading the question, you mustn't read the question as a storybook, or you'll be as if you are watching a movie. You need to be you need to start working. Okay, you need to start working out the problem as you'll be reading. So we have actually acquired the information that this carbon code acquired 60%. So in your memory, you'll be having this group structure that is okay. Okay, so we know that P acquired subsidiary on 1 May. Okay, this is 1 May 20x7. Okay, and our P in the mind is actually Cody. Okay, and S is Soles. All right, now the percentage acquisition was 60%. All right, which means the NCI was having 40%. All right, but now we are told that the reporting date is 30 November. So as a clever student, you must appreciate that from 1 May to 3rd November, we are looking at 7 months. So you'll be jotting down these notes as you'll be reading the question, because there won't be enough time to draw anything. All right, then you then have to do your standard workings. All right, this was working number 1. Then you go on to working number 2. All right, let us do that one together. Working 2. All right, this one has to do with your net assets. The net assets of the subsidiary. So we need to know at acquisition and then at reporting. At acquisition date, at reporting date. Now, at acquisition, the share capital of the subsidiary was how much? This one is assumed not to change, 40,000. All right, so which means at the reporting date it will again be 40,000. And then the retained earnings. The retained earnings of the subsidiary at acquisition. Okay, at acquisition, you know, we need to compute this figure at acquisition. For the reporting part of it, you just have to take the figure as given in the statement of financial position. Okay, at reporting date is just 69 as given. Okay, as you can see, it's 69. The reporting date retained earnings for the subsidiary was 69,000. However, the retained earnings at acquisition has to be computed, because the examiner did not tell us explicitly. He didn't tell us. Okay, as you can see, there is no such information everywhere there. We are only told that the subsidiary earned a profit of $9,000 in the year ended 30 November 2007. However, this subsidiary was acquired 7 months into, only become part of the group for 7 months. So we need to compute to adjust the pre-acquisition profit as well as the post-acquisition profit. Okay, so we come back here and we just pick, at the reporting I said just take the reporting figures from the question. So at reporting it was $69,000. All right, but now for the at acquisition figures, let us try to determine that. So RE at acquisition, this should be a balancing figure. All right, and we know the post acquisition RE, post acquisition, don't mind my handwriting, please don't mind. Okay, the post acquisition retained earnings, we know that this subsidiary made profits of 9,000. Okay, and for 7 months this should be 7/12. Okay, so 9,000 multiplied by 7/12, that's 5,250. Okay, and we know that the total retained earnings should amount to 69,000. Okay, let me just write it here. Earnings, they should amount to $69,000 because this is the accumulated figure. So it means for the 7 months they had made 5,250 in that year, but their retained earnings have accumulated to 69,000. So it means at the date of acquisition, the retained earnings were a balancing figure there, which is, let us use our calculators. 69,000 minus 5,250. This should be 63,000. 63,750. Okay, so that's the balancing figure there. All right, so we have to take that figure and slot it here as 63,750. So this is not always straightforward. Okay, this is not always straightforward. So you have seen how we have calculated the retained earnings at acquisition. Sometimes the examiner might be interested in you showing him how you determine that figure. All right, so let us sum the figures up. So this one gives us 103,750. So this is the net assets at acquisition, and this is the net assets at reporting date. Like I said, you also have to account for the movement, and usually this movement is attributable to movements in reserves, retained earnings, revaluation surpluses, and so forth. All right, now we have done the net assets. What about the goodwill? Let's calculate goodwill. I'm sure I've got enough space. Working number 3, goodwill. And for goodwill, we start with the fair value of consideration transferred. Fair value of the consideration transferred. And in this case, this was how much was paid. All right. Okay. I think there's a portion which they indicated the amount which was paid. Okay, Okay, now you can see that in the books of coding, we are having investments of 98,000, and that figure has been so far reserved for the cost of investment in the subsidiary. However, you will discover that the word investment doesn't mean that it doesn't always refer to in investments in subsidiary. It could also refer to other things, okay, other investments held in terms of Ifrs 9. All right, so you need to be very attentive to the detail. So as you can see, this subsidiary was acquired after paying $76,000 cash. So, and we agreed that for cash considerations, the fair value is the actual amount that was paid. All right, so the amount for this subsidiary is not 98,000. The cost of this subsidiary is not $98,000, but $76,000. So please, a lot of students could end up making that mistake. So we are saying it's $76,000. Okay, and then the fair value of NCI at acquisition. Remember, it's at acquisition. This one again is given in the question because we are given the fact that the 40% non-controlling interest was this much at acquisition. So they said it was $50,000. Excuse me. So let's put the $50,000 right away. Okay, then we can total up and we get our $126,000. Then we deduct the net assets working number 2. Our net assets were how much at acquisition? The acquisition figure is that one, $103,750. So the goodwill on acquisition should be $22,250. Okay, let's quickly do the working for the NCI, working number 4, NCI. And we want fair value of NCI at acquisition. This one was given as 50,000. Remember, the figure should just be the same as that one in working number 3. Okay, please replay your video there. All right, and then the NCI share of post-acquisition, NCI share of post-acquisition reserves. Okay, if there's been a movement in the reserves, remember that movement was there because according to our calculation, our working number 2, we can see that there has been a movement. Okay, there is a movement here from 103 to 109. So that's, we come here and say 109,000 minus 103,750. Okay, multiply by 40% because the NCI is a 40% group. So if we do our computation, we must get 2,100. So we add up, we get 52,100 as our NCI. Okay, 52,100, 52100. Then the last working we should do is for retained earnings. The retained earnings. Okay, we take 100% of the parent, Cody. Okay, the parent Cody was having how much? From the question, the parent was having 189,000. Okay, sure you're seeing this figure, 189,000. So we come here, say 189,000. Okay, and then we need to then talk of issues to do with other things which require adjustments. Okay, and from the question we read about issues to do with unrealized profit. As you can see, there were issues to do with goods which were sold at that November 27. The inventory of S included goods purchased at a cost of 8,000 from Cody, so from the parent. So if goods are sold from the parent to the sub, then it means that the retained earnings have to be adjusted. So let's do the computation in relation to that, so that we slot that figure to the retained earnings. So we can come down here and say working number 6, provision for unrealized profit. Okay, so we are going to say the profit in inventory, the inventory not yet sold. Okay, because we are told that all the inventory which were sold were not sold to the public, were still in stock. So that's how much in terms of percentage. All right, we are told that they purchased the goods at a cost of 8,000 from K at cost plus 25%. Right, so when they bought these goods, they were including a profit element of 25%. So which means this pen is invisible. The $80,000 there was also including a profit element of 25%. So we need to remove that profit element. Okay, so we know that there was 25% profit. Okay, so to remove that, we have to divide by 125. Right, to determine the profit element, multiply by 8,000, because the 8,000 included the profit element. All right, which means the profit element was 1,600. So we take this 1,600 as unrealized profit, okay, as PEP here. PEP, that is working number 6, 1,600. This one has to be removed. We also have to adjust the subsidiaries post-acquisition reserve. The post-acquisition profits or reserves. So the group is only entitled to 60% of those reserves. So 60% subs post acquisition reserves. In this case, the retained earnings of the subsidiary post acquisition. So we are saying 60% multiplied by 60% multiplied by the difference between 109,000 minus 103,750, as we did on the non-controlling interest. It's just the same here. So we are going to get 3,150. Okay, so we add up these three figures. and we must get 190,550. Okay, now that we have done all the relevant workings, it's now time for us to do the statement of financial position. All right, so as usual, we say this is the K group or the code group, consolidated statement of financial position as at 3rd November 20x7. All right, is this the correct year? Let me cross check. Yes, 20x7. Okay, now we start with the non-current assets. Non-current assets, you just have to write them in full in a formal paper. Okay, non-current assets, we get to the SFP and see what were they. There was property, plant, and equipment, which means we need to add up this PPE. Okay, so these are the items which have to be added on current assets. We have to add up this, and then you need to factor in if there are any current, current accounts. We need to deduct them. On the inventory, we need to reduce the profit element, the PAP, and so forth. Okay, for cash, we add up there, and then for if there are no liabilities there to be added up, so we ignore unless in the notes they say something. We'll look into the notes as well and to see if there is anything for the liabilities. Of course, there is also the current liabilities there. I did not see them. All right, so that's how we do it. So let us quicken up. So we saw that there is PPE to be added across. So start with the property, plant, and equipment. All right, and the parent was having 138,000. The sub was having 115,000. Add up, and this should give us 253,000. Okay, we also have got another non-current asset, which is an intangible asset, goodwill. And we calculate this one on working number 3, and we just have to slot in the figure which we discovered, and this was how much. Working number 3, where are you? Working number 3 was showing goodwill of 22,250. So we slot in that figure, 22,250. All right, now there is an aspect of investments. All right, and we said only the cost of the subsidiary is not going to be part of the non-current assets of the group, but other investments have to be considered as part. So our investments figure is going to be adjusted for the cost of the subsidiary. The figure was 98,000 for all the investments, but we need to deduct the cost of the subsidiary, 76,000, and the remaining investments are recognized as such. Okay, so we get a total of 297,250. This is the total value of non-current assets. Then we need to add current assets to get the total assets. So we start with the inventory. Okay, the parent was having 15,000. Okay, plus the subs 17,000. We need to deduct the PAP. Okay, the provision for unrealized profit of 1,600. This is working number 6. Okay, working number 6. So we get 30,400. We also have to think of the receivables. The parent was having 19,000. Okay, the subsidiary was having 20,000. However, there were no current accounts according to the question. So you can see it's not talking of any current accounts. Okay, so we need not to worry about that. Okay, so that's 39,000. Then lastly, there was cash. Only the parent was having cash of 2,000. We add up, we get our total assets. So 297, 250 plus 30,400 plus 39,000 plus 2,000. This should give us 368,000. 368,650. Then we move on to the equities and liabilities section. Okay. We start with the equity. Okay. Ordinary share capital. We take the parent's equity capital of 50,000 only. Then the group retained earnings. This was working number 5. How much were they? They were 190, as you can see here, 190,550. Then NCI, non-controlling interest, that was working number 4. And how much was that? That was 52,000. Okay, 52,100. Okay, then we then have to add up, and we get 292,650. Then we include the current liabilities. We have got the parents on 33,000 plus the subs on 43,000, and this gives us 76,000. If we add up, we get 368,650. This is the same amount as the total assets, as you have seen there. This is the total, total assets of 368,000. Okay, I think we've done justice to the question. Let's look at things to do with fair value adjustments. Sometimes you will discover that there would be need for a fair value adjustment. A fair value adjustment represents the amount required to adjust the relevant item from its current carrying amount in the subsidiary statement of financial position to its identified fair value. So you discover that when you value, or when you at the date of acquisition, maybe the sub's records might be showing land saying 400,000, which was maybe the cost value, okay, because land does not depreciate. But when you sell the subsidiary, the land, you discover that the fair value might be 500,000. So there would be need for, to account for the fair value uplift of, so there would be an uplift of 100,000, which has to be included. Okay, so let's look at this example to see how it works. Okay, so Hardy acquired 80% of the share capital of Prodin on 1 January 2023 for cash consideration of 1 million. At the date of acquisition, Prodin had retained earnings of 125,000 and a revaluation surplus of 100,000. At acquisition, the fair value of Prodin's plant exceeded its carrying amount by $200,000. At the date of acquisition, the fair value of the 20% non-controlling interest in Prodin was $380,000. The statements of financial position as at 31 December 2024 for the two companies are as follows. So these are the company, the statements of financial position for the two companies. As you can see, okay. Now, required, calculate the value of the net assets of Prodin at the acquisition date and date of reporting. So here you're only required to compute the working number 2 part of it. All right, so you need not to worry much about anything. The purpose of the example is for you to appreciate that the net assets computation might require you to factor in the fair value adjustments. Okay, so what is required is the net assets. So let's give it a go. All right, so you come here and say net assets of the subsidiary. Okay, the subsidiary is Prodin, of Prodin, and we are looking at acquisition date and at reporting date. These are the two dates we are looking at. Okay, so we can put thousands. All right, so we start with the share capital. Usually you will be led by the structure of their balance sheets, their statements of financial position. So these are the net assets, ladies and gentlemen, we are talking about. Okay, those are the net assets which we are talking about. So the balance sheet itself will give you a clue. So we start with the share capital, the revaluation surplus, the retained earnings, and then you factor in other adjustments. So the share capital, this one is assumed not to change. So usually the figure is shown here for Prodin, okay, because we are looking at the net assets of Prodin at acquisition. So the share capital is usually the same, 400. Sorry, there should be 2 zeros. All right, and then the revaluation surplus. The revaluation surplus, unless told otherwise, this one is going to be the same. Okay, we are told here that the revaluation surplus was excuse me, 100,000. So we just have to slot it as it is, because at the reporting date it was 100. Okay. Now, the retained earnings. At reporting date, they were how much? We just have to pick the figure 300. But at acquisition, there could be something or some adjustments to be made. At acquisition, they were 125. So you just have to pick the figure as given, 125. That's how we do it, ladies and gentlemen. It's not magic, just simple. 125,000. That we are also told that at acquisition, the fair value of Proteins plant exceeded its carrying amount by 200,000. So the carrying amount was lower by 200,000. Okay, so we then have to have an entry. Okay, this is a new entry so far. Fair value adjustment. Fair value adjustment. How much? 200,000. At reporting, 200. But sometimes at reporting, the figure could be different after we factor in depreciation. In this question, we are not told of any depreciation to worry about. Okay, so this is how it goes, and then you need to add up and you get your assets. The total assets at acquisition were 225,000, and at reporting they were now 1 million. Okay, so that's how it goes, ladies and gentlemen. Please just replay the video and you'll get to understand it better. Now let's move on to other aspects. Now we are now heading towards the epilogue of the course. Now, it could be less judicious to consider basic groups without talking about investments in associates. As a way of, closing the chapter or the whole lecture, there is need for us to appreciate what associates are and how they fit in the group perspective. An investment of this type is something less than a subsidiary, but more than a simple investment. All right, the key criterion here is significant influence. All right, so when we talk of associates, we are talking of significant influence. Now, just as a note, investments are usually the acquisition of equity shares of less than 10% in a company. Okay, usually they are 10% or less, right? But when you're talking of significant influence, this is usually between 10% and 50%. Between 10 to 50% usually does significant influence. All right, and then above 50%, that's control. Okay, above subsidiary, that's above 50%. Okay, the 50% exactly usually fits joint ventures, okay, joint operations or joint arrangements, something like that. All right, but sometimes a company might own 50% but still have control, but those issues are outside basic group, uh, the basic group costs. All right, we just have to rely on these basics. Now, an associate is an investment where significant influence matters. When we talk of significant influence, we are referring to the power to participate in the financial and operating policy decision of the investee, but which is not control or joint control of those policies. So the idea is you might be having the influence or the power to participate. Okay, you're just participating, but you're not going to give the final say. All right, so if a shareholder is a 30% shareholder, that person is a significant shareholder and he has got some power to participate in the decision making. However, he does not have the ultimate control of the company. All right, so that's the background, ladies and gentlemen. Now, what is the evidence that significant influence exists? IS 28, that is International Accounting Standard number 28, states that if an investor holds 20% or more of the voting power of the entity, it can be presumed that the investor has significant influence over the entity, unless it can be clearly shown that this is not the case. Significant influence can be presumed not to exist if the investor holds less than 20% of the voting power of the entity, unless it can be demonstrated otherwise. Okay, so you can see that what is 20% is the benchmark. Sometimes if you own more than 10% but less than 20%, you might as well be an associate. Okay, you might as well be an associate if you can prove that significant influence exists or you have that significant influence. All right, so the existence of significant influence is usually evidenced in one or more of the following ways. All right, so let's now look at these ways in particular. Now, representation on the board of directors or equivalent of the investee. Sometimes, let's say where a board is a six-member board of directors, but you are having the power to appoint two of the directors, then obviously we can say you have some significant influence. Okay, you do have some significant influence over that company. Participation in policy making process, where you are consulted to give a say, therefore you have some significant influence. Material transaction between investor and investee. You will see that in the company, the intra-group trading activities, your company is actually participating in major transactions. Therefore, we can actually see from a distance that you do have some influence. Interchange of management personnel. Sometimes your directors are sent to manage in the company, in the parents' board. Therefore, or the parents' board of the, directors are also sometimes are appointed or tasked to become part of your management. Then we can also say there is some influence there. Then, provision of essential technical information, where this is happening, that your company is actually required to provide certain information or technical know-how, then we can as well say that you do have some significant influence. All right, so these are actually the indicators of this significant influence. according to International Accounting Standard number 28, paragraph 5 to 6. Now, we normally account for associates using the equity method. IS 28 requires the use of the equity method of accounting or equity accounting for investments in associates with certain exceptions, but these are beyond the scope of this course. Consolidated statement of financial position. A figure for investment in associates is shown in the consolidated statement of financial position, which must be stated at cost at the time of the acquisition of the associate. Okay, so we expect to see this figure in the statement of financial position. This amount will increase. So initially, the figure will be the cost of the associate, but the amount will increase or decrease each year by the amount of the group's share of the associates the associated commons increase or decrease in the post-acquisition retained reserves. So the equity method will be showing the cost plus or minus the increase in the associate's common value, all right, which is attributable to its earning power. All right, let us look at this example to send the point home. Paletta Co. acquires 25,000 of the 100,000 $1 ordinary shares in Acca for $60,000 on 1 January 20x3. In the year to 31 December 20x3, Acca Co. earns profits after tax of $24,000, from which it pays a dividend of $6,000. How will Acca Co.'s results be accounted for in the individual and consolidated accounts of Paletta Co. for the year ended 31 December 20x3? So we need to be systematic in the way we attack the question. So the statement of financial position, the consolidated statement of financial position will include the asset investment in associate, which is calculated as follows. All right, so because the question is saying how will Acca Co.'s result be accounted for in the individual and consolidated accounts of Paletta Co. for the year ended 31 December 20x3. Okay, so this is the consolidated position. Okay, the consolidated statement of financial position will include the asset, excuse me, investment in associates or in associate, which is calculated as follows. So this is the consolidated SFP position. Okay, where we have the cost of the investment, which is 60,000 according to the question, and then the share of associates profit for the year. We are told that this was a 25% associate. However, the whole associate made profit of 24,000. Okay, it earned profit of 24,000. So which means that's 25% of 24,000. This is 24,000. Okay, applied by 25%. So we get that's a quarter, 6,000. All right, and then we have to reduce any dividend which has been paid, which was 1.5. Okay, so 1.5 dividend was received. So we are going to have the ultimate balance of 64,500. That's the equity accounting part of it. This is the amount of or the value of the associate in our statement of financial position. However, in the individual, okay, in the parent's records, we also need to appreciate the entries which are made. So here, okay, let's first look at the parents records. In the parents records, okay, in the parents record, we are going to see the investment, okay, which is going to be recognized on 1 January. Okay, recognized at cost on 1 January 20x3. Okay, so in the statement of financial position, on 1 January 20x3, we're going to recognize the associate at cost in the parents records. Okay, then the only entry we are going to see that is in this parent company's financial statements, that is the statement of profit or loss, we are going to see only the entry of the dividend received. Okay, we're going to see the dividend that has been received. Okay, so in the profit or loss, of course, this lecture was not dedicated to the profit or loss, but just for our understanding, we're going to receive income from associate. We're going to record this as a credit. Okay, that's 1.5 thousand. Okay, so we are going to debit cash and credit income from associate 1.5, 1,500. Okay, the other entry which we might expect to find in the statement of profit or loss is an impairment loss. Okay, if the asset, this associate has been subjected to an impairment loss, then we are going to recognize any impairment loss in the statement of profit or loss in terms of IAS 36. Okay, if there is an impairment, then IAS 36 will be applicable in that case. So basically what we are saying is the equity accounting is not going to be applied to the by the parents in its own records. Okay, in their own records, they are only going to recognize the asset at cost throughout, unless it has been subjected to impairment. That's when the asset will be reduced in value. Okay, that's when the asset will be reduced in value. So in the only entry we expect to see is the cost. So the asset will be held at cost in the parent's records. It will be held at cost unless there has been some impairment, which is going to be an issue which is subject to IAS 36, impairment of assets. Okay, but now when it comes to the consolidated statement of financial position, that's when we do our equity accounting. Okay, so that's we hold the investment at cost, that is 60,000. Okay, that's the opening value of the investment. Then add share of associates profit for the year, and we determined it to be 6,000, and deduct an dividend that has been received of 1.5. We can't add again that dividend. Why? Because it has already been accounted for as income, remember. All right, so it has to be reduced here. Remember, in this 6,000 there was that dividend, so we need to deduct it. Okay, and then we come to that 64,500. So remember, the share was 6,000 and 1.5 has been received and recognized. Now we need to recognize the remainder of 4.5. So we are going to debit, okay, we are going to debit the investment in associate, debit investment in associate, okay, 4.5, and credit the share of appropriate profit, share of profit, which is a P&L figure. Okay, so that's it. All right, so by debiting the investment, we are increasing the investment of the associate in the statement of financial position, the consolidated statement of financial position. But like I said, you are not going to do this process in the individual records of the parent. In the parent, you're going to hold the investment in associate at cost less n impairment losses. Less n impairment losses. Are we together, ladies and gentlemen? Okay. Now, let's now look at this question. So, are associates part of the group? Are associates part of the group? The answer is no. Group companies include only a parent and the subsidiary. To consolidate is simply to add together, and only the result of the parent and the subsidiary can be directly added together in full. Remember, for consolidation purposes, associates are only an issue where the parent is required to prepare consolidated financial statements. That is, when there is one or more subsidiaries. If no subsidiary is in existence, then an investment in associates can be accounted. Okay, let me repeat this statement. If no subsidiary is in existence, then an investment in associates can be accounted for as an investment at cost, or in terms of Ifrs 9 in the parent company's individual records. Okay, and this re-emphasizes the point that equity accounting is for group accounting. Is a treatment for group accounting, so for consolidation purposes. Okay, now let's touch a bit on simple investments, just as a recap. When an entity invests in the shares of another entity but acquires neither control nor significant influence, this is referred to as a simple or trade investment. In this case, the investment is carried as a non-current asset in the settlement of financial position, and any dividends received from the investee are included in the statement of profit or loss. So remember, there was an example where I said that the word investments doesn't refer to the cost of the subsidiary all the time. Sometimes it refers to simple investments, which are also investments in terms of Ifrs 9. Okay, usually these Ifrs 9 investments are held for the accretion of wealth. Accretion of wealth, usually for speculative purposes and so forth, for trade. Okay, so just remember that when you talk of significant influence, that's when we talk of associates. Okay, where the investment is usually 20% to less than 50%. And then when the investment is above 50%, then there is now a subsidiary. There's now control. Okay, where it is now, sorry, the direction of my sign there, okay, where we will be talking of greater than 50%. The shareholding is more than 50% of the total equity shares of the company that is being acquired. Then we can say there is now a subsidiary, there's now control. Okay, although I indicated that there are certain situations when even if a company purchases more than 50% of the equity shares, it could not be considered a controlling shareholder. There are those situations. Okay, but for now, this is the basic. So simple investments are usually less than 20%. Okay, usually less than 20% because IAS 28 straightforwardly said that any investment, if an investor purchases more than 20%, then they are automatically considered to be having significant influence over the investee. So obviously, if the entity purchases less than 20%, we can safely assume that they are operating as a simple investment. Okay, that investment is considered a simple investment and can be accounted for under Ifrs 9. Okay, let's see the summary of consolidation procedures. Basic consolidation consists of two procedures. Number one, cancelling out items which appear as an asset in one company and a liability in another, and we call these ones current accounts, and they should be eliminated. So to cancel out is to eliminate. Then adding together all the uncancelled assets and liabilities on a line by line basis. Okay, that's what we mean by consolidation. Then the asset investment in subsidiaries in the parent company accounts always cancels with the share capital of the subsidiary companies. The only share capital in the consolidated accounts is that of the parent. This is why I said always take 100% of the parent's equity share capital as your equity in group accounts. Okay, so ladies and gentlemen, I hope you have been covered, okay, with regards to basic consolidation. So far, I hope you have gotten what you were looking for. Please look forward for other similar courses where we'll be tackling these accounting issues from time to time. Until we meet again, may the good Lord continue to bless you. Amen.